Hey, Adam Hoeksema here from ProjectionHub, and this is the fourth video in a 6-part series on how to buy a small business with an SBA loan. And in this video, I'm going to be specifically focused on the financial due diligence that you'll want to do when you're looking at acquiring a small business with an SBA loan. We've already talked through kind of the first 3 videos on kind of at a high level, the process of acquiring a business. We've talked through SBA specifically and what you need to look out for and understand about SBA before you start even searching for a business to buy. And then we talked about how to find a business to buy. And now we're kind of at the point where, hey, we've got a business that we think we want to buy. How do we do the due diligence to understand whether this is a good deal? Is it going to fit for SBA? And this is really the nitty gritty. I like this detailed kind of financial analysis, and I'm going to be walking you through what we do for clients. And so hopefully you can do that for your own deals. All right. So before I dive into that, just a little bit of my background. So I was an SBA lender myself for 12 years, closed about 1,500 SBA loans while I was the executive director of an organization called Bankable. And then while I was at Bankable, I started ProjectionHub on the side as a side hustle to try to help our clients create financial projections because my loan clients, my borrowers always struggled with creating projections. And so I wanted to make that process easier. So we started ProjectionHub. This picture here is me winning some SBA hardware, an award from the state of Indiana district director there when I was a lender. So have a lot of experience both on the SBA side of things as well as the financial projection, financial modeling, and particularly over the last couple of years, most of the deals that I'm working on have now been acquisition deals. And so I really want to talk you through how we look at doing that due diligence and reviewing deals. All right, so before I dive into that, we are going to put in the description of the video below, we'll put a link to the last 3 videos that we published, and then also to the next 2 as those come out. So you'll be able to watch all of those. But I do encourage you, if you haven't already, it probably does make sense to at least watch episode 2, the Understanding SBA Loans, before you watch this financial due diligence, because I think that will set the groundwork. All right, let's go ahead and dive into this. So today's objective, what we want to be able to do by the end of the session, we need to know what financial documents you should be requesting from the sellers, how to spot some red flags, how to calculate and validate SDE, which is seller's discretionary earnings, which seller add backs are okay, which ones are lenders going to accept and not accept. We want to think about how you value the business using standard industry multiples, and then how to determine whether the deal is going to cash flow with an SBA, and hopefully help you be confident in your offer and that your offer and your deal is going to make sense and work for SBA, so that you don't have to, make an offer to the seller, have them agree on that. Then you go to the SBA and realize your offer structure is never going to work. Now you have to go back and renegotiate. That's always going to put a bad taste in the mouth of the seller. And so that's the goal. We want to try to help you avoid that. Okay, so when does the financial due diligence actually happen in the process? So I think there's kind of 2 distinct kind of processes or areas of the process where you might do some due diligence. The pre-LOI, so before you have made an offer to the seller, you want to do some due diligence to make sure that your offer is going to work, that it's going to make sense from an SBA perspective. And then post LOI, once the seller has agreed on the terms of the deal, at that point, you can ask for additional information, additional financial documents that you're probably not going to get during the pre-LOI stage. And so we're going to look at kind of both of those areas here. What do you need to request from the seller? You need the last 3 years of business tax returns. You need the year-to-date profit and loss and balance sheet. So that's kind of the standard base package request. I think you really need that in the pre-LOI stage. And then post-LOI, once you've got an agreed upon offer, that's where I think you can ask for other details like the accounts aging report, the receivables aging report, the accounts payable aging report, list of any debt, a debt schedule, key customers and contracts with those customers, a list of the key employees and their salaries, or really a list of all the employees and their salaries. So you want to be able to look into that. But that you're probably not going to get on the front end. You really have to have tax returns. If the seller provides you with just a QuickBooks report, profit and loss and balance sheet, that is okay. It's okay to have that, but ultimately the SBA is going to underwrite on the tax returns. And so I always recommend just get the tax returns on the front end so that you're not faced with surprises later, because so often we will be working on a deal and while we're working on what QuickBooks says, and hey, this looks pretty good, it looks like it can work. And then we look at the tax return and they reported something completely different. It's not even close to the same numbers here. And so what gives here, right? And so I think get the tax returns on the front end, I would recommend. Okay, so now once you get the tax returns, what do you do with them? Well, what we would recommend is get them into a spreadsheet where you can start to do some analysis. And so I've got a screenshot here of our spreadsheet that we use to kind of analyze acquisition deals. We'll put a link in the description of the video below to this acquisition template so you can grab this on your own. But what we're doing here, we want to see first on the revenue side, what are we looking for? We are looking for a trend in sales. And so in this example, this is an example of a real deal that we were helping with. The sales were increasing year to year. And so that was encouraging. If you see sales decreasing, and especially if it's a multi-year decrease, that's going to be a major red flag to a lender, because they're not going to know when will the bleeding stop, when will those decreases find their bottom and turn around. And so it's hard to calculate what future cash flow could be for the loan if it feels like, hey, we're just going to continue dropping. So ideally, flat or increasing revenue is important. The next thing you're going to look at, you want to see the gross margin trend. And so this is kind of confusing how we've got this set up here in yellow highlight, but you've got the cost of goods sold expenses. And we just did like a little customized calculation here for the gross profit by year. So we said, okay, in 2023, gross profit was 63%, but then it went down to 41%, then back up to 44%. And so, that's a question of, hey, why are margins decreasing? That's something you want to look into. Sometimes that's just an accounting thing. Sometimes your margins are getting squeezed. And so you want to understand that. And then on the expenses here, the operating expenses, what we do is we calculate all of these as a percentage of revenue. So we said, okay, salaries and wages was 10% of revenue in 23. It was up to 13%. And then 12% of revenue in 25. You want to look for things that jump out at you that are significantly different year to year. So here's an example. Legal and professional was $2,500, $11,000, and then all of a sudden $72,000, right? So what was that big jump? And you're going to need to dig into that. In this particular case, there was a legal dispute, and that was a one-time thing, and it was over and settled. And so, it was truly a one-time expense. And so we could add that back later. But those are the types of things you're looking for. Then ultimately, you're going to see the net income and net profit here down at the bottom. Now, in this case, it's before any add backs. We're looking at that net profit. And it's a little discouraging because it's down in 2025, even though revenue is up, right? But next, we're going to get into some add backs here shortly. I guess before I jump into the add backs, I guess some things that I like to do here is kind of benchmark against the industry. So we're going to, find the industry that the business is in. And then, here's like a screenshot of ChatGPT helping us kind of understand what's the typical revenue growth, what's the typical cost of goods sold as a percentage of revenue, operating expenses, and so on, and see if the seller is kind of in line with the norms there. And if they're not, what gives? What's the difference? There's a number of different ways you can get industry data. I think obvious option is ChatGPT or Gemini or Claude. I mean, pick your AI tool. Honestly, probably pick 2 or 3 of them, run the same process or the same questions to multiple. You can average them together and you're going to get a pretty good idea of what the margins and industry norms are going to be if you do that. Okay. Some red flags to identify, red and yellow flags that I think you want to be on the lookout for here once you get those financials. Declining revenue 2 to 3 years in a row. I kind of already mentioned that. If the business wasn't profitable at all, that's going to be an issue. If there's no profit, there's no cash flow available to cover debt service. And so you're probably not going to qualify for an SBA loan. Now, there is a difference between tax return, net income, and cash flow available for debt service, because we're going to get into those add backs, what can be counted as an add back. So you may start with a lower net income on the taxable income side of things, but once you start adding things back, it may look a lot better and maybe a lot different. You want to be aware of major customer concentration. So if you've got one customer that's 50% of revenue, that's way too high. That's almost an unsellable business at that point. Some yellow flags: revenue or profit spike in the year before the sale. That is always a question, right? So if it's like been steadily 10% net profit, and then all of a sudden, right the year before we had the sale, 20% net profit, and then they're trying to value the business on the most recent year, that's a red, yellow flag. Expenses that seem outside of the industry norms, high owner compensation relative to the size of the business, and then those inconsistencies between the tax return and the P&L are always something that you're going to have to dig into. And then any excessive seller add backs. So we'll get into that. Okay. Add backs. We're finally to add backs. So the taxable income on the tax return only tells you part of the story. And there are a number of things that can be then added back to that taxable income to come up with what's considered seller's discretionary earnings, SDE, or ultimately it's like, what is the cash flow available to make payments on the debt? And so here's a kind of a screenshot here of like, you're starting with that tax return net profit here. Let's say it's $100,000. Then you can add back the owner's salary. You can add back interest expense, add back depreciation. Maybe there's discretionary expenses like a personal car, travel, health insurance. You can add back certain non-recurring expenses. So you might have a business that starts out with a taxable income of $100,000, but by the end of it, your seller's discretionary earnings is $225,000. And in the example that we were looking at previously, if you remember, that final year, that third year actually had the lowest net income, even though it had the highest sales. But by the time we added in all of these add backs here, its seller's discretionary earnings in the final year was $172,000. It was actually the highest of the 3 years. Now, why is that? And what are some examples of things that we were able to add back here? So charitable contributions, that's something that's discretionary. Meals, sometimes lenders let you add back meals, sometimes they won't. Auto and truck. So in this business, the business did not need a vehicle. So this was really the owner's personal vehicle. This is discretionary, so they were able to add that back. Personal cell phones. A lot of times you see the personal cell phones run through the business. And this was kind of a weird one. They rent. So a lot of times you'll see the owner owns the building and then the operating business pays rent to that business. But you also, sometimes you could have situations where, let's say you are buying this business, you're going to move the business into a building you already own. And so you're not going to have that rent going forward. So if you can make the case that you're not going to have the rent going forward, it can be an add back. Utilities, they were paying some personal utilities in this case. As long as they can document that to the lender, they'll probably accept that. That's kind of a gray area. Lenders may not be too excited about that. And then legal and professional, again, this was that big jump in expenses, but we could prove that and document that it was a one-time legal issue. There was a settlement and that's over with. And so once you added all those things back, you end up with your seller's discretionary earnings. Now, that's ultimately, that SDE is what lenders are going to be looking at to determine, can this cash flow? Things that you want to be aware of, I think we're going to get to that next. So add backs that will generally be accepted, that owner's salary or distributions or compensation of officers, it could be called. You can add this back. So let's say the seller pays themselves $250,000 and it's showing up as a business expense. Okay, you can add that back, but then let's say you are going to need to pay yourself $100,000. You have to do a negative add back effectively, or really what you can add back is the net between what the seller was paying themselves and what you're going to pay yourself, right? So the lender is going to expect and assume that you as the new owner will need to get paid something, most likely, to operate the business. Every once in a while, I see lenders willing to approve a deal with no owner's compensation built into the model, and that could be because they've got a spouse with outside income that has strong outside income, or they've got another business that provides income for them, or they may own some rental properties that provide passive income that can cover their lifestyle. So, but that's what you're going to be assuming, is that you're probably going to have to pay yourself something out of the business that you're buying. So keep that in mind. You can probably add back things like owner's personal health and life insurance, depreciation, amortization, interest expense certainly will all be added back. One-time fees, if you can really document those clearly, and then above market rent paid to the owner or the related party. What they're probably going to reject, meals and entertainment, it's just hard to prove. You don't want to mess around with a bunch of receipts. It's just, hard to document. Personal travel buried in business expenses. Again, it's hard to say like what's personal travel versus what was travel for the business. One-time repairs. In a lot of businesses, there might be a one-time repair. Like you might have to repair the HVAC system once every 10 years. And so it feels like that's a one-time repair, but also once every 10 years, you have to repair the roof or the water softener or pick an expense. But there are often repair expenses that folks like to try to add back and say they were one time, but really you just need to expect that as a business owner, you're going to have one-time expenses all the time. So those are hard to get agreed upon from the lender. Family members on payroll, unless you can prove that they weren't needed. So you really got to prove that, we put this member on payroll. You have to basically just, admit to cheating on your taxes, right? Like I paid this person, they didn't do anything. It's going to be hard to document, right? And then just vague personal expenses without clear documentation. If you've got, the business might buy certain supplies or buy things on Amazon, and you might also be using the same Amazon account and buying personal things, right? And the lender doesn't want to go through your Amazon account and try to pick out, yep, this looks like a business expense, this doesn't. They're probably just not going to, if you have it on the tax return that was an expense for the business, they're not going to let you add it back. You're not going to get to kind of take advantage of the tax situation and then get it back on the acquisition side of things. Okay, so once you have that seller's discretionary earnings and you've kind of made all of your adjustments to what you think the lender is going to agree upon, you want to get an understanding of what the value of the business is. And so what I typically suggest is go to Biz Buy Sell, and at Biz Buy Sell, they publish valuations by industry. And so you can look at earnings multiples by industry. And so in this case, this was a butcher shop. And so let's say earnings multiple 2.6 to 2.4 here for the most relevant industry. And so what you're doing is you're taking let's say the 172,000 here and multiplying by that earnings multiple to come up with the kind of highest valuation. So here we're saying 172,000 times 2.61 is 448,000. And, what I would suggest here, you're probably, the seller's going to always want to value it higher, probably. And what you need to keep in mind, if you're working with SBA, the SBA requires a third-party appraisal. So if the asking price is way above the industry multiple, it's not going to meet, the appraisal is not going to be high enough. And then you can't get an SBA loan for that amount. Like the appraisal's the ceiling on that. So it kind of, that SBA process will actually help protect you as the buyer from way overpaying for a deal. So let's say what happens if you've got a deal where it's like, I really want to buy this business. It's priced at $1 million. It only appraises for $750,000. You could still buy that business, but you're probably just going to have to come up with the difference as equity. So you're going to have to come up with more equity from yourself or from investors, because the SBA is going to be capped at lending against what that appraised amount is. So that's what you need to keep in mind on appraisals. All right. So it's got to appraise and it's got to cash flow. It's got to cash flow the loan. And that is all kind of tied to debt service coverage ratio. And so, we'll look at this butcher shop example here. What we hadn't added in yet was interest and depreciation. So we had gotten to that seller's discretionary earnings, and we had these additional cash adjustments. So we got ultimately down here to this estimated cash flow. And based on the proposed loan that we wanted, our proposed annual debt service was going to be $129,000. And so we can look at historically and say, all right, if we had that large of a loan and we had this cash flow, what would our debt service coverage ratio, what would it have been historically? And so in 23, it was 1.95. 24 was 1.19, 25, 1.42. SBA lenders are going to typically want a minimum of 1.25 debt service coverage ratio. I will say technically it can go as low as 1.15, but you got to really ask yourself, do you even want something that's how close to the sun do you want to fly is a question. So I like to use 1.25 as a minimum, at least in the most recent year. If you said, okay, it was only 1.15 back in 2 years ago, but it's grown since then, it's improved since then. Okay, that makes more sense. Now, the way that lenders are going to view historical debt service coverage ratio is going to be different lender to lender. Some lenders will say, we want you to have hit 1.6 each of the last 3 years. Okay. And then other lenders will say, we want you to hit 1.6 just in the last year, or we want you to hit 1.25 in each of the last 3 years, but we want the most recent year to be 1.5, right? So every lender is going to have this slightly different. I think the main thing you need to just understand is if all the years are below 1.25, that means it's not going to fly. And so what you're going to need to do is reduce the loan amount, which probably means you need to reduce the purchase price. And so we kind of give some examples of the math. You can kind of back into, okay, if I knew I had this much cash flow and I need to have this level of debt service coverage ratio, how much could I potentially borrow? But if DSCR is too low, your options: reduce the purchase price, increase the down payment, get a seller note to reduce the bank debt. You'll probably have to put that seller note on full standby or walk away, find a different deal. Here's kind of how we can work backwards from debt service coverage ratio and see how much could we actually borrow on a deal. So here we said the business SDE was $143,000. In an example, we need 1.25 DSCR. Means your maximum annual debt service is $114,000. And a standard SBA acquisition loan is a 10-year term. Let's call it 10% interest. So that means we can max out at a roughly $700,000 loan. And so let's say you put $100,000 down, your maximum purchase price here is in that, we're saying $780 because you're going to have some closing costs as well. So, that gives you a rough idea. And so if the seller's asking for $1 million and this is your math, it's not going to work. One thing to note is if the deal includes real estate, if real estate portion is 50% or more, or maybe more than 50% of the total deal, then you can put the whole loan on a 25-year term instead of a 10-year term. That's going to lower your annual debt service and increase the amount that you can borrow. So and actually in that particular example that we had, the butcher shop included significant real estate. And so in that one, they were able to do a 25-year term. And that's why they were able to spread that out and lower that monthly loan payment. All right. So you may have heard about in due diligence, this idea of a quality of earnings report. A full quality of earnings report, which is kind of like a mini audit, is the way I like to think about it. It is going to cost you between $10,000 and $30,000, probably between 2 to 4 weeks. It's not an audit, but kind of like an audit. It is, I'd say, best for deals that are over $2 million or complex situations. If you're going to spend $2 million, personally guarantee, put your house on the line on an SBA note, then it probably makes sense to spend $20,000 to be sure that you're doing as much due diligence as you can. If, on the other hand, you are looking to buy a business for $200,000, it probably doesn't make sense to spend $20,000 doing due diligence or doing a quality of earnings report. And so something that I do, so we don't offer full quality of earnings reports. That's just not something that we've done. But we do offer what I call this quality of earnings sniff test, which costs you around $1,000, quick turnaround, couple days. What we're going to do is get the financials into the spreadsheet that we showed you here. We're going to analyze it. I'm going to put my SBA lender hat on and look at it from an SBA lender and say, here's what I think about the deal. Here's how I think the lender's going to look at it. Here's some things that I'm concerned about or some add backs I think you really need to question. But that's it. That's kind of at the high level. Whereas in a full Q of E report, they're like reviewing contracts. They're reviewing bank statements. They're probably actually communicating with the seller, asking the seller questions. And in the quality variance sniff test, we're not doing any of that. We're just taking the data and the reports that you've been provided and doing a kind of a desk review of that and giving you our analysis. So we've done over 50 of these in the last year and a half or so. I think it's a great value and really helpful, especially on the smaller deals. So if that's something that would be helpful for you, feel free to reach out. You can reach me at adam@projectionhub.com and be happy to help there. Okay, so that's kind of the due diligence course here. So action items before the next course here. We want to get financials for your top deal. So request the last 3 years of tax returns, get P&L statements, sign an NDA, build this analysis spreadsheet. So create columns for each year, put in the revenue and expenses and kind of do that calculation that we are showing you to point out red flags. You need to calculate your SDE and run that debt service coverage ratio test to see whether it can actually cash flow or how large of a loan it can cash flow. And then if that's going to work, like if it only cash flows a $500,000 loan, but they're asking for $1 million, unless you have $500,000 of cash to put into the deal as equity, then deal doesn't work, doesn't cash flow. So that's the math you're trying to figure out. All right, so next steps, course number 5, we're going to talk about once you've got a deal that you've made an offer, you've got an accepted offer on, and now you need to get lender ready package. So how do I get my deal ready to go into underwriting? We're going to talk through that. And then finally, course 6, you're at the finish line almost. We'll be closing the deal and what to expect there. So that's it. If you have any questions, again, feel free to reach out, support@projectionhub.com, or you can email me directly at adam@projectionhub.com. Again, we'll put the links in the description of the video below to our other courses here in the series. And if you found this to be helpful, it would be amazing if you would like the video and subscribe to our channel so you can make sure to catch the next episodes as we publish those. And we'd love to hear from you. All right, thanks.